50 Cent. He is one of my favorite rappers. You guys know I love hip-hop music. 21 questions. This is one of the best tracks on the Get Rich or Die Trying album. And so I posted to my community on Facebook and Twitter, hey, I want to answer 21 questions here on ppcian about dividend investing in the spirit of my man 50 Cent, and rest in peace, Nate Dogg. This is just a exciting video. I'm going to answer 5 questions here. We'll do the rest of them, the other 16, in future videos because it's going to take a while just to get through the first 5. I'm up late at night. It's Monday, 11:30 at night. This is how we do it. Thug lifestyle, thug life investing right here on ppcian, dividend investing for everyone. All right, so I'm going to jump into the questions. First one on today's video is from my man, Sure. He's on Twitter. He's always put in the best tweets out there supporting the community. He had a really good question, and it goes like this. Ian, what are the top 5 stocks besides Disney for a young child's account? Well, actually, I picked the top 5 including Disney. I just realized that, but it's all good. I have 2 young kids. If you've been following my channel for a while, you know that I have purchased Disney for each of them. Disney stock. What a great company to invest in my humble opinion, for young children because they have so much time on their hands to compound. And so I was thinking about this question. This is a really good question. And I assembled a portfolio, if you will, for young children, a sample portfolio that kids could really enjoy. Kids of all ages. Quite frankly, this portfolio that I'm about to present on the screen for all of you to see, I think it's a really good portfolio for anyone who kind of skews younger. It's kind of a younger person's portfolio because you'll see the stocks that I include, they're blue chips, they're world-class companies, they're stable, but they tend to have lower dividend yields, higher dividend growth rates, lower payout ratios. They're more towards delayed gratification. They're more towards making big income, big passive income, dividend income in the future, which is perfect for a younger person. And so I want to show that portfolio on the screen right now. Check it out. And before I even get into the specific stocks, there are 3 themes that really guided how I assembled this portfolio to answer my man's question. And the 3 themes go like this. 1, I wanted to pick fun names that keep the kids interested. Because if you're a child, I'm trying to get my children to really love investing. They're too young now, quite frankly, to really grasp the concept of dividend investing, but they'll get there, and I'm getting them started. But think about it. When you're a kid, there's so many things to learn. There's so much to do. So the most important thing, I think, to have kids really appreciate investing is to present companies that are interesting, that they're fun to the kids. And so that was the first thing. 2, I wanted to realize that, look, low starting yields are okay. Kids aren't going to be paying for stuff with dividends. They have time on their side. Who cares if the starting yields are low as long as the dividends are growing? Because we all know through this channel, through the multiple analyses I've presented over time, that it's all about that yield on cost. And the yield on cost for these stocks, you'll see in the examples on the screen, are phenomenal, even though the starting yields are really low. Also, I wanted just to keep in mind that, hey, kids, they have something on their side, even more so than the rest of us. They have time, and they can use that time to their benefit to allow the miracle of compound interest, of compounding, to happen. And so, therefore, I picked these 5. And obviously, the first one is Disney. So, Disney, I've talked about this a bit recently, so I don't want to get into too much more depth. But check this out. Price per share is $149.69. The forward EPS for the current fiscal year is $5.46. Forward PE is 27. It's obviously priced to perfection. But again, I want to remind you all of something. Think back when you were a kid and you saved up a bunch of money. Where is that money now? I'll give you my example. Some of you, maybe you're really good. Maybe it's still in the bank. You never spent it. I'll tell you what I did. Right around senior year, junior year of high school, I took all the money I'd ever saved, my life savings, and you know what I did? I went to this company called the Tire Rack, and I basically bought 17-inch rims for my vehicle, for my car. Back then, like, hey, 17-inch wheels now, not a big deal. But back then, that was kind of the biggest you would go. Like, maybe you'd do 18s or something. But back then, 17s, that was making a serious thug life statement. And so basically, living like my man Puck, rest in peace, picture me rolling. Basically, I wanted to be picture me rolling in real life. And so I bought the wheels. I went to the Tire Rack, basically spent my life savings on this, got a lot of enjoyment out of it. But you know what those wheels are worth now? Nothing. I don't have the car anymore. When I sold the car, did I even get any value from that? No. No. And so, and these were nice. These are aftermarket, like OZ wheels. Really good wheels. Anyways, think about that. So you think about that in most kids are probably the same. And so I don't want to generalize, but I'm just saying a lot of kids, you're buying toys or trading cards, comic books, vehicles, this or that. Most of these things, they more or less, for all intents and purposes, become worthless, basically. They're worth nothing. And so this kind of frames how I think about this portfolio. Like, yeah, Disney is trading at a PE of 27, but what's the better alternative? Disney at a 27 PE or OZ rims for my vehicle? Hey, you know, there's a lot of value that can be derived through enjoying one's youth, enjoying one's car, enjoying the aftermarket modifications that come along with that. That being said, when you look at it on a financial basis, the wheels, all that money is gone. Disney stocks, say it's overpriced at 27. Who cares? Because when kids have such a long time frame, I just look at it a little bit differently. So I just want to provide that context. Maybe you agree or disagree. That's how I look at it. For people who are really young, in my opinion, valuations don't quite matter as much as it does for someone at my stage where I'm a bit older. So I tend to buy value because I'm closer to using dividend income to pay all my bills, and I'm already paying some of my bills with dividends. So the starting yield for Disney is $1.76 per year. And they pay 2 dividends a year, by the way, so that's both added up. Dividend yield is a small 1.18%, but the payout ratio is low, and only 32%. And they're growing that dividend about 9% per year on average for the last 5 years. I think that will continue for quite some time. So what does this bring us to? I did a quick analysis. If they keep up the last 5 years compound annual growth rate, what will that be 30 years out? What will that be 40 years out? Because think about it. Someone who's just a kid now, 30 years out, they're in their mid-30s. Someone who's just a kid right now, 40 years out, they're just in their mid-40s. And so that's not really that long. And so you start wondering, well, what happens if you compound that growth rate on the dividend? Quite frankly, for my analysis here, I'm not even including reinvested dividends. I'm just assuming dividends are maybe stockpiled as cash. So it's almost a little bit conservative. That said, it's probably also a little bit aggressive because I'm assuming the last 5 years of growth will continue forever. And we all know over time, there will probably be diminishing returns. And so the purpose of this analysis is just for illustrative purposes. It's not perfect, but it gets to showing the value of, 1, why starting yield doesn't matter, 2, how time is one's greatest asset, and 3, why it is so amazing if you can get your kids to start investing at these young ages. And so check it out. Disney, after 30 years, is paying a dividend annualized of $22.62. How do I get that? I basically take the current dividend, I multiply it by 1.09 or 1.089% to the 30th power. And so I'm taking the current dividend, I'm extrapolating out if it keeps growing at that 8.9% rate year after year after year for 30 years, it's going to be $22 a year. and change. So I take that 22, I divide it by the current share price. After 30 years, the yield on cost is 15%. Not great, not bad though. A lot better than 1%. And quite frankly, this might be overstated in some ways, but it might be understated in other ways because I'm not counting reinvested dividends. So 40 years out, it becomes a 35% yield on cost. This is another nuance I wanted to point out here. When you're an investor, you see this with Warren Buffett actually. Once you're already rich, because you hear this, the rich get richer. It's true. Once you're already rich, you're already at a certain point, an extra 10 years of compounding, it does miracles. And so you see here, like literally your yield on cost goes from 15% to 35% in the last 10 years. And so this is why time is so important. It's so important to start young. And it's so important just to hold on and you start thinking like, hey, should I tap into my dividends now or wait another 10 years? If you can wait that extra 10 years, it goes to show what happens in the last 10 years. And those last years is when the best compounding starts happening because the numbers get bigger and bigger and bigger. It's the compounding effect. And so it's just interesting. This is why the rich get richer. It's really right here in front of you in math. And so those last 10 years. And so check this out. Stock number 2 for, by the way, before I get to that, Disney, one thing worth mentioning, the way I did this analysis on compound annual growth rate is back in the day, 5 years ago, they paid 1 dividend a year. Now they pay 2. And so to do an apples to apples comp, I took the dividend from the comparable 5 years ago and divided it in half. So they've changed their dividend policy. Also, when I do a lot of these examples, these analyses, I have to look and factor in for stock splits as well. And so in the next 2 stocks I'm going to talk about, which are Starbucks and Nike, you'll see some stock splits factored in there as well. And so just something to keep in mind when you do these types of analyses. Don't just look at the data from before and then assume, oh, wait, the dividend went down. No, it didn't go down. It's just that the stock split. And so the dividend before the comp has to be cut in half. And so there's these nuances that are really important to take into account. So the next stock I picked was Starbucks. Man, I love this. Can I preach just a bit? I'm gonna upset some people, and you know that's all right. It's all good because it's late at night, doing thug life. So I gotta upset some people out there. I'm gonna tell you something. I'm a real estate developer. I'm on the road a lot. I went into Starbucks today probably 4 times. I went into different locations. The first time I went, I actually spent a good hour and a half working there on my laptop, and I purchased my grande iced mocha and a butter croissant. And so I'm a paying customer. I'm honestly cannot stop drinking it. I'm addicted to it. All right, but don't hate on me. Parent of 2 kids. That's what it needs. You know, I don't get a lot of sleep. You guys can see that I know you see it in the comments, but it's all good. But I gotta have my Starbucks. Here's the deal though. Man, I love this company because it's so multi-generational. You see all the generations there. Why did I put it in a kid's portfolio? Every day when I'm at Starbucks a lot. And so every day around 3 or so when I'm at Starbucks, 3:30, kids are getting out of school. You see all the young kids coming in. They come in with all their friends, big group. They're all there at Starbucks. And so why did I put Starbucks in this portfolio? One, I put it there because it's like a Disney, really high growth story. Stable, blue chip, ain't going anywhere, but it's still got a lot of growth. It's expensive. If you're a kid, it doesn't really matter if the stock is expensive. Or let's say you're a teenager or young 20s. This portfolio is kind of for young people. But when I was assembling it, I was mainly thinking like, hey, what would I do for my kids? And so that's how I created this hypothetical portfolio. But this portfolio could apply to a lot of different scenarios. Anyways, that's not what I'm trying to preach, though. What I'm trying to preach here is there's people giving Starbucks, they're hating on Starbucks, saying you're allowed to people to come in and use your restroom if you don't buy something. Good grief. I mean, people are going to get mad at me like when I was talking about Gillette. I'm not even going to get into that. But I went to Starbucks today, like I said, 4 times. All 4 times I used the restroom. Only one time I bought something. There are times I go to Starbucks to use the restroom. I'll tell you, the other day, we were at the farmer's market. My son had to use the restroom. We went into Starbucks to use the restroom. Now, I did end up buying something, but there have been times we've gone, look, these days I can't go in without buying something because, like I said, they got me addicted to it. But I'm just saying, in the past, sometimes we go, we leave, we use the restroom. And so what I'm trying to say is, I just want to commend Starbucks, quite frankly, for that policy, because sometimes you just need a place to go. And so everyone got to go to the bathroom. And so thank you, Starbucks, for being friendly and accommodating to allow people to use it. And so I just want to also ask the people out there, if you're hating on people going there using the restroom who do not buy coffee or who cannot afford to buy coffee, just think about your own situation and count your blessings that you are in a situation where you can afford to buy coffee. And why would you want to hate on the company or hate on people who are coming in and cannot afford to buy a coffee? Rather than hating on them, why not go over to them and buy them a coffee? And so that's it for today. I'm gonna get off my my soapbox here. I don't want to preach too much, but I'm just saying, I see this in my comments sometimes, and I love you all. I love you all so much. Thank you for the support, the subscriptions. Hope I don't lose subscribers over this, but I just got to give my piece to the conversation. That's how I feel. Anyways, Starbucks. So price per share, $83. Forward PE is a 27. Super expensive. I can't bring myself to buy more here, although I am reinvesting dividends on this amazing company. Dividend yield is a tiny 1.96%. And payout ratio, it's actually a little bit higher, 53%, 53.95. So it's not bad, though. Anyways, the 5-year compound annual growth rate of the dividend is 20%. It's not sustainable. But let's just look at the metrics just for the fun of it. If we extrapolate that 20% growth rate in perpetuity for the next 30 years, we're getting a 554% yield on cost. And after 40 years, 3,641% yield on cost. Obviously, these numbers are not realistic because the rate of dividend growth over the last 5 years for Starbucks, it's not sustainable. But it gives you a directional indication of what can happen for long-term Starbucks shareholders. Hey, let's say it doesn't get to 550 after 30 years. Let's say it gets to just 50% yield on cost. Hey, that would be just fine with me. 100% yield on cost, just fine with me. And so that's why I do the numbers more than anything. I'm painting with broad brushstrokes to give direction of where things could go. But anyways, that's what's up with Starbucks. Perfect stock, in my opinion, for kids, because kids love Starbucks. I see them there all the time. That's where they're spending their money. It's what you're spending your money on. And so that's what I want to, in the famous words of Raekwon, and he has a song called Sneakers. It's for all the sneakerheads out there. This gets me to the next stock, Nike. A lot of people have been asking me about Nike, and it's what I'm spending my money on. It's those Jordans. And so just ordered another pair, celebrate the Christmas holiday, bought myself an early gift. Man, I got the Jordan 4s, the cool gray. I can't believe I still found one. Champs Sports, shout out. Hey, thanks for still having the inventory on that sneaker I wanted to pick up. So I copped that one, the cool gray Jordan 4s. Anyways, so people have been asking me, Ian, what do you think about Nike? I like Nike as a consumer. I've always stayed away from fashion-oriented stocks from an investment standpoint. We've all seen what happened with Under Armour, for example. Trends come, trends go. If there's one stock in consumer non-discretionary, consumer discretionary, that in the fashion that would make sense to someone like me, it'd probably be Nike. And so I'm starting to think, though, kids, what do kids like? These same kids that come into Starbucks, I'm looking at them and I'm like, hey, what shoes are they wearing? A lot of them are wearing the Nikes, just like me. Thank God, I thank my lucky stars. I can wear Jordans every day. I don't wear them every day because if it's raining or I'm going to a job site, I'm wearing my Timberlands. And so you know how we do it around here, like Ice Cube. And so what it comes down to, though, for me is I thank my lucky stars. I love these shoes. They're comfortable. I'm reliving my youth. The 4s are my favorite. 5s are actually my favorite, but they're not comfortable, so I wear the 4s. which I love. I got my collection's really centered around 4s. Anyways, boy, I start thinking kid portfolio, what do they love? Hey, they like these Nike products. They like the shoes. They like the clothes. And so I put Nike in here. Nike is trading at $92. It's got a forward EPS of 2.97, puts the PE at 31. So people ask me, Ian, are you buying Nike here? I'm buying the Jordans. I'm not buying the stock yet because it's just too expensive for me. But and look at that, the dividend payout, dividend yield is just $1.05%, 1.05%. And the dividend per year just under $1, 98 cents. Payout ratio 33%. Compound annual growth rate last 5 years of the dividend almost 12%, so it's growing pretty quickly. And this one kind of looks to me like a Disney type of stock. 30 years out, your yield on cost is, so it's a little better, I'd say, than Disney. Not as good as Starbucks, but 30 years out, yield on cost 30%, 40 years, 93%. Obviously, a lot of assumptions in there. This is if the last 5 years predict the next 30 or 40 years, which they probably don't. But again, the numbers are directional. They show the magic of being a kid and investing so young, not putting your money into the custom rims for your car, which end up being worth nothing, and just putting money in one of these types of stocks, holding it for a long time. Life-changing. Absolutely life-changing. If I could go back in time, I wouldn't change anything because I really enjoyed my youth, and I enjoyed that car. I enjoyed those modifications. It was an important and exciting part of my youth. That said, man, kids who choose this path, right on. And so anyways, I'm not buying Nike here, so this is kind of a double question because a lot of people have been asking me, Ian, what do you think about Nike? I love it. I love the Jordans. I'm like my man Raekwon. It's what it's what I keep spending my money on. And so anyways, check that track out. It's fabulous. One of my favorite hip-hop tracks of all time. Man, I love that track. And so sneakers. And so moving on. What would be the next one? Apple. Oh my goodness. So many of you have commented. What are the toys that kids play with these days? Mind you, young kids like my kids, they're not getting much screen time, if any, because it is not very good for younger kids. So they're playing with more traditional toys, thank goodness. But as kids get older, they get into older grades, so maybe they're in high school. You see them. You have kids. A lot of you do, or you've seen them around town. What are they doing? They're on their phones. They're on their iPhone. And so what's a natural stock for a kid-centric portfolio that kids would like? Because I want to pick stocks that are enticing, that are motivating to the younger investor. They would like stock like Apple. And so I put Apple in there. I'm going to talk more about Apple in another question today, so get ready. This is another great question from the community. Anyways, the price per share, 266. It's up a lot. That said, the PE, it's not bad. It's still a 20. So out of this whole group, it's the best value right now. And so dividend yield, 1.16%, not much. Payout ratio is only 23%. So it is the lowest payout ratio of the bunch, which I love. A lot of room to grow. They've been growing the dividend on average about 10% per year. 30 years out, 40 years out, you guys see it. Nice yields on cost. I round out this kid portfolio answering my man Jershur's question with PepsiCo, ticker PEP, my number 2 favorite stock of all time. I love PepsiCo. And so with Pepsi, this one, I would say of the bunch, it's the slowest growing company. But I just started thinking like, hey, kids, what do they like? They like Disney. They like all that. They like a Starbucks coffee. They like their shoes. They like their electronics. But you know what? They also like snack foods. Like, hey, who doesn't? This doesn't apply just to kids, but everyone. But I think for kids, if they're building a portfolio, it's important to have something that's tangible that they understand. Everyone understands soda. They understand Lay's chips. They understand food and snacks and beverages. And so I thought Pepsi, hey, good stock to have in there. And so this one's trading at a forward PE right now of 24, real expensive. I'm reinvesting dividends, not buying more at these prices. Dividend yield, highest of the bunch at a 2.85%, so it brings a little bit of yield, current yield into the portfolio, not that it needs it. Payout ratio, also the highest of the bunch at almost 70%. And compound annual growth rate of the dividend, lowest of the bunch at 7.8%. And so your yield on cost for this one is also, after 30 years, 27%, and 40 years, 58%. And so nice stock to round it out. Anyways, this is my answer to that first subscriber question. To summarize, if you have kids or you're thinking about a portfolio for kids, these are the types of stocks I look at. However, let's say you don't have kids, you're a younger person, or you're just a growth-oriented investor. This could be an interesting portfolio to mull over and think about for other situations as well. And so I think this is a good portfolio. Hypothetically speaking, if I were just looking for a scenario where the investor has a lot of time, lots and lots of years ahead, that's this hypothetical portfolio right here to answer this particular question. Now, obviously, I'm just speaking hypothetically here as always, and everyone out there will have to do their own due diligence and find the solutions that work for their own particular situation or their own kid's particular situation, because everyone is differently. But what I'm speaking about here is hypothetically through the lens of my own kids. This is what I would do for my kids. Although I'll tell you right now, they both only own Disney stock because we started with Disney and was keeping it focused on Disney for the time being. Great question. So that's question number 1. All right, so question 2, I'm going to pop this on the screen. This is a question about Apple. It comes from my man, Jason K. He wanted a shout out. Shout out, Jason. Thank you so much for your support. Means the world to me. Thank you. And so Jason was asking, in regards to Apple specifically, but could be any stock that appreciates rapidly. I'm up 60% on Apple for the year. With such a low yield at 1.18%, it would take 30 years to match the amount, that amount from dividends. The gains are all long-term capital gains. Would it be a good idea to cash out and redeploy that position in a more value-oriented position? And also, like, follow-on question was, do I practice tax loss harvesting to offset my tax liabilities from dividends? Wow, good question, Jason. This is a really good one. So I'm going to answer this one through data. First and foremost, let's just look at this. This data, I'm like you, I'm up a lot. I bought 2 lots of Apple. I used to own Apple a long time ago, sold it, needed the money for something else, and anyways, got back into Apple last year, thankfully. And so 2 lots I bought last year in December. One was on 12/13, one was on 12/26. I'm up 55% on the first tranche, 76% on the second tranche. And so what's funny, between the time I bought the first tranche and the second tranche, you'll see this on the screen, I was down 12%. Back in December of last year, people were saying, oh, the sky's falling. Oh, Ian, maybe you made a bad mistake buying Apple. You're down 12%. No, I didn't. I averaged down and I'm up 55% on the first tranche, 76% on the second tranche. This is what's so fun about the stock market, because when things are falling and you're averaging down and people are criticizing you or you're criticizing yourself, you're thinking, am I doing the right thing, the wrong thing? Well, it worked out for me with Apple, thank goodness. But I'll tell you, none of this matters. This capital appreciation, whatever, I buy this stuff to pay bills with cash flow. And so that doesn't mean as much to me, and it may to some, because there's different types of investors. For me, I'm a cash flow investor, just pay the bill with dividends investor, but there are other types of investors. And so anyways, what means a lot to me is what I'm going to show on the screen right now. And this is what I just shared in the kid portfolio, actually, because Apple was one of those stocks. But basically, it's this stuff. But here I highlight a few things, and it's the forward PE of 20. It's the payout ratio, which is really low at 23%, and it's that compound annual growth rate of the dividend, which is really high. When I put aside my capital appreciation, I just look at the fundamentals, they're good for Apple. And so for me, case closed. I'm not selling any of my personal Apple here. That's how I personally look at it for my personal situation. But let's say, hypothetically, it ran even further and the PE was even higher. Hey, I own stocks like that. We just looked at Starbucks. Huge PE of 27. And so I'm not selling Starbucks. For me, when I say I'm buy and hold forever, I really am. For better or worse, I don't like to penalize winners. If something's a winner, oftentimes it will continue to be a winner. And if something has a high PE, oftentimes it will continue to have a high PE because it means that it is growing really quickly. I may not always be right with this philosophy, but it's what's always worked for me. So for me, I'm literally at the point in my investing career where I don't sell stocks, and even if they're a bit overvalued. Apple, I wanted to show because it's not. I think it's actually still a good value. Quite frankly, I could buy Apple here and be comfortable feeling like I'm getting a fair value for my money. I actually think as a tech stock here, it's a good value. But the question goes beyond that. It's more about capital gains, and it's also about, I think what's implied is not only capital gains, but not as good of a value, like overvalued or fair value versus other stuff that's out there that could very well be a awesome value right now. For example, something like an ABV, for example, like ABBV, which is a stock I love and I own. And so question comes, oh, sell Apple, put it in ABV. I just don't do that because I don't like to penalize winners. And tax loss harvesting, same thing. What a lot of people do is they sell stuff that's down. Good example is Apple last year. Tranche 1, I bought for 171. Tranche 2, 151. But what some people will do, and that was in December of last year, what some people will do is they're like, oh, I bought it 171. I'm going to sell it now at 151 because the year's not over. It's December 26th. And I can take that loss on paper and cancel out capital gains or cancel out dividends, whatnot, on taxes. The reason I don't do that is fast forward now to November of 2019, and I'm way up. I'm up 55% on the first tranche, 76% on the second. And so for me, when something is down on paper, up on paper, for better or worse, I don't take much action on it. I just look at fundamentals. I buy and hold forever. I do tend, though, to allocate future investment dollars where I see the value. And so Apple, like I said, I think there is still some value there. Starbucks right now, unfortunately, is overvalued a bit, in my opinion. Not for a kid portfolio, but for someone like me, late 30s, bit overvalued. I'm reinvesting dividends, but not adding more here. So the way I vote is not by selling stock, but it's more about where I put net new dollars in the market. But then again, there are a lot of wise investors out there who look at things differently than me. So I'm just speaking to my personal situation here on this channel, what has worked personally for me. Fabulous question, my friend. So I want to go to the next question now. This one comes from my man, John K. Thank you for this question. He says, being new to dividend investing, what is the difference between selecting and investing in your own dividend stocks as compared to investing in index funds, which focus on dividend stocks aside from the fun factor? Thank you. So I had this question before. I did a whole video on it a long time ago. I'll link to it in the description below. But I thought I would answer again. I'm going to share on the screen right now a little table that I put together that I think is going to help answer this question visually better for the community. And so I'm going to talk about pros and cons with stocks versus ETFs. So first and foremost, you buy an ETF. Let's look at diversification. I have 43 dividend stocks, but generally speaking, for the average person, it's instant diversification buying an ETF. ETF is usually going to win for easy diversification. Buy one thing, you get a lot of underlying stocks. And so ETF, exchange traded fund, it's a great way. It's a mutual fund of sorts that is traded on exchanges, not actively managed. Usually it just kind of mirrors some kind of benchmarks such as the dividend aristocrat or top yielding dividend stocks or dividend kings, these types of things. I haven't actually actively researched a lot of ETFs because it's just not my territory, not my area of expertise, but that's generally what they try to do. They own a basket of stocks. They're not very, very actively managed. There's not much turnover, which is good because the fees tend to be lower than a super actively managed mutual fund. But they're a mutual fund of sorts that's traded on the exchange, such as NYSE or NASDAQ. And so anyways, you buy the ETF, you buy one thing, one ticker, and you get all the underlying stocks. So instant diversification. So something else, fees. Stocks will always win on fees, in my opinion, because it's, now there's no fees for the major brokerages out there. And there was just news today that Schwab is now acquiring TD Ameritrade. And TD Ameritrade just acquired Scottrade. And so there is a lot of consolidation happening in the industry right now, which is really interesting. But anyways, Schwab started it all, and Schwab is doing no commissions. And so anyways, you buy stock without commission, you buy and hold forever. That's really low on fees. You buy an ETF, there's always some kind of fees associated with an ETF because it's an actively, or it's a not very active, but it's a managed mutual fund of sorts. There's a company, a mutual fund company that sponsors it, that wants to get their fair share of your and my money. And so ETFs, they're always going to have fees, so they kind of lose their stocks win. What I'm checking on the thing on the screen, the table, check mark marks the winner. And so ETFs win on diversification, stocks on fees. I would say stocks really win on the control, both on quality and your price that you buy. Stocks, I can cherry pick just the ones I want to own. ETF, there may be stuff in the ETF you don't want to own. You don't have control over it. So that's where the quality comes in. But on the sale price, where it comes into, hey, I want to deploy more money. ETF, I'm buying all of the stocks. And so at any given time in the market, there's always going to be stocks that are overvalued and undervalued. For example, right now, I think AbbVie is undervalued. However, Starbucks Spirit is talking about, I think it is overvalued. Let's say the ETF owns both of those stocks. I put money into the ETF. Well, I'm buying one overvalued stock, one undervalued at the same time. But if I'm just buying individual stocks, I can cherry pick. I'm going to pick just to buy AbbVie now. I'm going to wait for Starbucks later till it goes on sale. And so there's the control factor on the sale price with individual stocks. You can cherry pick the ones that are on sale, if you so choose, which is what I often do. And so that's where individual stocks win. Simplicity. ETFs clearly win. If you are someone that wants simplicity in your life, you don't want to be up at 11:30, now it's 12 now, in your garage late at night, dealing with stocks, you're not passionate about it, the thug lifestyle. Hey, there's something to be said for ETFs. I got mad respect for the ETF investors out there living their best life, enjoying life, not getting too bogged down in the details. That's a clear benefit of ETFs. Active and engaging. That said, I love what I do. I love being actively engaged with stocks. If you're someone like me that likes to be actively engaged with stocks, hey, there's something to be said for this strategy. And so individual stocks win for those people that want to be active. If you want to be passive, ETFs win. And so this is kind of redundant with simplicity, but I'm giving ETFs a win here. Some people prefer a passive strategy. That's where ETFs win if you're a passive investor. So pride of ownership, I guess you could have it with both, but it's just not the same. Look, when I go to Starbucks and I use the bathroom there 4 times in one day, thank you, Starbucks, for that opportunity to use your facilities. I'm on the road a lot. One of my goals this year was, and I might or might not have time at the end of this thing. We'll see if I get there. If I don't, I'll do it in the next one. But I'm kind of reflecting on my goals through the year. And one of my goals was to lock up another commercial real estate property. Well, it just happened. I have a commercial real estate property in escrow, in addition to the one that I'm already developing, Thug Life. How did I do that? I've been on the road a lot. I've been driving all around. I've been working hard. This is why I'm vlogging here on YouTube so late at night, because I've been grinding, and thankfully Starbucks allows me to do that because I have use of their restroom when I'm on the road. Anyways, I guess enough about that, but I have so much pride for owning that company. Beat the market. I kind of checked both of them here. I'll tell you, when you invest for dividends, in my humble opinion, it is always better than investing in the market, because dividends provide passive income now and in the future that can be used to pay the bills without selling shares. And what's so beneficial about that, and what's so cool about that, is it applies to people that own both individual stocks and ETFs, dividend-oriented ETFs, I should qualify. When I say ETF here, I'm talking about ETFs that focus on dividends, dividend stocks. There's ETFs out there that focus on other stuff, but this question was framed around dividend ETFs. Anyways, I would say both in some respects, at least the way I look at it, they quote unquote beat the market, because I just don't think it's a sustainable strategy to invest in stocks that you have to end up selling to pay bills. It's just not for me. Talked about it at length here. I know some people do well with that. They like it. Mad respect to you all. But for me, both of these strategies kind of, I shouldn't say beat, because I guess that's a tough word to use here, but I guess it's kind of like hack the market. That's a better way to look at it. Both dividend stocks, individual stocks, and dividend ETFs, they hack the market. It's a hack to get that passive income, which I love. So customize your portfolio. Obviously, dividend stocks, individual stocks win there. Check out my how to invest $10,000 video, which I'll link to in the description below. There are only so many different types of dividend-oriented ETFs. However, think about it. If you're a young investor, maybe you're a kid, or you're the parent of a young kid, you might want a portfolio kind of like the one I was talking about earlier. Or let's say you're late 30s like me. You may want a portfolio like I have, my 43 stocks. Let's say you're just getting started out in your 60s. I have a lot of subscribers like that. I have a sample model portfolio for that hypothetical situation in my How to Invest $10,000 video. The beauty of individual stocks is you can customize something that meets your needs, meets your age, where you are in life. It meets your risk tolerance. And it just meets the types of assets you want to own. Maybe you want some master limited partnerships in there. Maybe you want some real estate investment trusts. Maybe you also want to throw in some consumer non-cyclicals like Starbucks or like PepsiCo. You can do that. You can cater it to your specific situation. With ETFs, there's only so many different types of dividend ETFs. It will never be as customized to you as you can do with individual stocks. Okay, exposure to small caps. It's going to be harder with these ETFs. If you want exposure to really small companies, and I own a few of them, individual stocks, it's going to be a must, just because they're too small. They're too small to get picked up by the ETFs. And we talked about exposure to REITs and MLPs. Going to be easier with individual stocks, in my opinion, if you're going that route. I didn't tally these up for a reason. There's no one right choice to answer this subscriber question. It comes down to the individual person. You have to look, of these buckets, of these comparisons, what do you value? What type of person are you? What's more important to you? That's the one that makes sense. Honestly, at the end of the day, are ETFs going to outperform individual stocks, or individual stocks outperform ETFs? I think you can outperform ETFs with the individual stocks, quite frankly. That being said, this kind of goes back to kind of beat the market, why it's kind of a tie. It was a nuance for that particular comparison. I think they're both going to perform very well, a dividend ETF or individual dividend stocks. I think you have the chance to slightly outperform with the individual stocks, but quite frankly, it comes down to more than that, and that's why I have all of these comparative factors. And so I hope this helps. I know a lot of you out there just starting out trying to figure out which strategy is right, and some subscribers in the community, they do both. They have the dividend ETFs and the individual stocks, but for me, all stocks. That's what works for me. So thank you for that question. Moving along, let's talk about Hormel Foods. So this is a question I got. I'll put on the screen from my man Erlinger. He said, what's your opinion on Hormel Foods? They got 40 food products that are either number 1 or 2 in their category, paid dividends for 90 years, increasing dividends for 53 years. Last increase was the 10th consecutive year of an increase above 10%. I like Hormel Foods. I don't own Hormel Foods because I already own other stocks in this category, and I can only own so many consumer non-cyclical companies that are in the packaged foods space. I like Hormel because they have some awesome brands, including the Applegate hot dogs and sausage brand. They got Spam. Shout out to all my friends from Hawaii. I love Hawaii, favorite place on earth. Try to visit there all the time. And I know Spam is very popular in Hawaii. It's a staple of the Hawaiian diet. They own Skippy peanut butter, which is my favorite peanut butter represent. So they got a lot going for them over at Hormel Foods. Again, I don't own Hormel literally because I own other stocks in this category. Anyways, I want to pop it on the screen real quick. Check this out. So Hormel versus General Mills versus Campbell's Soup. Basically what you see is Hormel has the highest PE. It's a PE of 24 versus 15 for General Mills, 18 for Campbell's Soup. They have the lowest starting dividend yield of 1.96% versus the highest for General Mills at 3.72, second highest at Campbell's Soup for 2.99. They have the lowest payout ratio, so they have more room to grow, 48% versus 58 at General Mills versus 55 at Campbell's Soup. And the compound annual growth rate, it is awesome. It's a 16% the last 5 years, whereas General Mills is nothing. It's at 3.6, Campbell's even lower at 2.3, so on and so forth. And so you'll see 40 years out, 50 years out, you're going to get better yield on cost with Hormel, much better yield on cost. Although, I think what you see here for General Mills and Campbell's Soup is a little misleading because growth rates have been slower in the last few years due to company-specific reasons. With General Mills, it's because of the Blue Buffalo acquisition they're digesting. Campbell's, it's because of some restructuring. It will return. So, literally for me, what it comes down to is I stop here. I could dig into Hormel. Maybe I will in a future video. But I already own other competitors in the space. I like my General Mills because I think it's the best kind of value in the space. I like my General Mills and Campbell because they also have iconic brands in their portfolios. They have higher starting yields. I'm an investor now that I like to have the fast-growing companies in the portfolio, like my Starbucks, like my Apple, those type of companies. But I also like to have my companies that give me some current yield, like my General Mills of the world, even though the dividend's not growing quickly, even though the stock's not growing, company's not growing as quickly as something like a Hormel. They balance each other out because I do have needs for dividend income in my life right now. I'm already using some of it to pay some bills, and it will only increase over time. And so for me, it's a balancing act. If I were to start over and I were only to pick one consumer packaged goods food company, consumer non-cyclical, and I was looking for something with higher growth, I'd probably pay attention to Hormel pretty closely as compared to General Mills and Campbell's. And so it's a good stock. I'll tell you, I'm not just going to write it off. Like, I quite frankly just write off JM Smucker. I know I'm gonna kind of offend some folks. I hope I don't. I love you all. Look, they got some good brands, but they got that coffee business, that at-home coffee. I think it's popular with certain people, but at the end of the day, the future of coffee, in my opinion, is very clear. It's Starbucks. That is the future. And so I just worry about that company. And so that one I write off for those reasons. And I own another one in my portfolio. I own Danone. I'm honest. Look, I'm one of the only YouTubers who I'll criticize myself. I'll hate on my own mistakes. Why I buy Danone? I want to own a French company, and I like that they're kind of in the healthy foods and the dairy products. Other than that, I don't have a good investment thesis for Danone. If one company in my portfolio had to go, it'd probably be Danone. It would be up there. I'm just saying, I'm being honest and real with myself. Never lie to yourself as an investor. Never fool yourself. Be honest with yourself. I'm honest with myself all the time. Critical of myself. It's what you got to do. Anyways, I wouldn't do that with Hormel. What I'm trying to say is I think Hormel is a great company. I like it. It has a different growth profile than the ones I own, but I just gave you why I own the ones I own. I own it because they give me more current yield, which it all works. I got other stocks in the portfolio that are the growers. There's no one right answer, but I like it. It's a cool company. So I got to move quick here because we're running out of time, running against that 1 hour mark. I don't want to push this above 1 hour. And so last question for today. All right, so Pascal, he said a lot of people commented lately that monthly dividends are the best way to help you compound faster. But if you buy close to X date of a yearly paying company, the yearly company should be better. Can you explain your view on this? Does it have an influence on what you're doing? I love this question because I see so much talk about it. I've done some videos about monthly dividends. They get a lot of views. A lot of people like companies that pay dividends monthly because when a company pays a dividend, it can get reinvested, and then the reinvested dividend can start driving more dividends. And so the more frequently you're paid dividends, it kind of accelerates the compounding machine. And so it entices people. And I own a company like this. I own Realty Income. And so that's the monthly dividend company that I own. Here's the deal. I did an analysis. It's in another video. I love this analysis. Check it out. I'll link in the description below. I'll put it on the screen. It shows my profile of dividends throughout the year, what I get by month. What I have concluded is basically it is not a good idea, in my humble opinion, to pick stocks based on how many times a year they pay a dividend. First and foremost, it always comes down to picking quality. Pick stocks that are quality. And so highest quality, and then later figure out the dividend payment schedules. And I know sometimes, like very rarely, I'll buy certain companies because they pay certain months and I'm trying to even out my dividends through the year. But more or less, and I haven't even looked at that when I'm buying a stock. I only look for quality. And so to answer this question very quickly, a lot of people like monthly companies because they're thinking the dividends compound quickly. It's true, they do, and I own one, Realty Income, but at the end of the day, that is not a selection criteria for me because I think it could lead me down the wrong path. I think it could lead me towards stocks which are not the stocks I ought to be owning. However, one thing that I have done, which is what I'm showing on the screen, is once you own stocks, look at when they pay their dividends throughout the year. When you're trying to round out your months and trying to even out dividend income throughout the year, then once you already own stuff, you can kind of look, well, which ones pay on different months, and it can help you kind of smooth stuff out throughout the year. And that, I think, is a practice that makes some sense. But the practice of just buying to compound quicker, for me at least, it doesn't make sense. I just like to buy quality because what I find at the end of the day, best returns are going to come from quality. It's not going to, surely the reinvesting dividends helps and it's good. But before that, the fundamental, bar none, that has to happen is it has to be quality. It has to be super, super premium quality companies. Those are the 5 questions for today. This is why I couldn't do 21 questions today like my man 50 Cent, because the 5 takes me an hour. And so I love you all. Please subscribe if you enjoyed the video. Thank you so much for hanging in there. I know this has been more than a week since the last one. These videos take a lot to do, these long form videos. And so before I leave today, I just want to do some quick shout outs. I want to do some community shout outs. It's Thanksgiving coming up. I'm thankful for the community. I love you all. And so I just want to shout out a few people. First and foremost, I want to shout out Marco, Whiteboard Finance. He just gave me a shout out. This is an amazing YouTuber, personal finance YouTuber, who has grown his channel really quickly because he offers so much value. He has a lot of background in the auto business. Talks about so many other things on his channel, entrepreneurialism, personal finance, all kinds of stuff. Thank you, Marco. You're the man. I want to give a shout out to Jason over at JMac Investing, JMac Dividend Investing. And so there's a lot of channels now in the dividend community. And I think we have the best community out there. This is what it's all about for me. It's about the culture. I love engaging with everyone out there. I don't always comment on all the other creators' videos, but I always try to be conversational on the social media, on Twitter, on Instagram, etc. So shout out JMac. I'm thankful for our community here, and I don't do it enough. It's Thanksgiving coming up. I'm thankful for all of you. I love you all. And anyways, before we go, full disclosure, all right, I am long the stocks mentioned today. Well, first and foremost, my kids are long Disney, ticker symbol DIS. I am long Starbucks, ticker symbol SBUX. Apple, ticker symbol AAPL. PepsiCo, ticker symbol PEP. AbbVie, ticker symbol ABBV. I am also long General Mills, ticker symbol GIS. Campbell's Soup, ticker symbol CPB. Danone, ticker symbol DANOY, and Realty Income, ticker symbol O. Those are the stocks that I own in my personal dividend stock portfolio. Today's video, by the way, is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in stocks, stock market, anywhere else, please consult a licensed financial advisor first. Just sharing my journey here for fun and entertainment. As always, additional disclosures in the description below in each of my videos. I love you all. Happy Thanksgiving. Be blessed. Spend time with your family. Wishing you an amazing holiday season. I will see you in the next video.